It's official now. The Indian economy is slowing. Hello and welcome to this special edition of Indianomics. I'm Lata Venkatesh. The Central Statistical Organization has said that India's GDP will grow at 7% this year compared to the previous estimate of 7.2 and last year's 7.2%. In the third quarter itself, GDP has come in at 6.6%. Since the first two quarters grew very strongly at 8 and 7%, that's an average of 7.5%, by reduction, the fourth quarter is likely to come in sharply lower, maybe around 6.3, 6.4% GDP. Let's come back to Q3 itself, the quarter that just ended. Agriculture has slowed to 2.7% compared to 4.2 in the second quarter and 4.6 in the year-ago quarter. This explains perhaps the deep farm distress. Manufacturing has grown again somewhat tepid at 6.7%. That's also slower than the 6.9% in Q2 and 8.6% year-ago Q3. Construction has certainly picked up to 9.6% versus 8.5% in the second quarter and just 8% year ago. But trade, hotels and transport, which is a large category in the services sector, has slowed to 6.9% from 8.3% year ago. If you looked at GDP from the expenditure side, then there are very bright performances coming in from both private consumption and capex. At least that's what the numbers say. Private consumption has grown at 8.3% in the third quarter, while capital formation, gross fixed capital formation, did even better at 10.6%. Exports are very good, a strong 14.6%. However, government expenditure has lagged, coming in the third quarter at just 6.5%. That's a lot of numbers, I know, for you all to digest, but let me go straight away for some qualitative comments. I have two very important guests with me, Dr. Pranab Sen, economist, former chairman of the Statistics Commission, and a former chief statistician of the country. I also have with me A. Prasanna, chief economist, ICICI Securities primary dealer. And Prasanna, I must tell you, Dr. Sen was the only one to call the numbers right. He did expect that the third quarter GVA number will come in only at 6.3%. That's what we have. So, Prasanna, let me start with you. The residual number, fourth quarter, looks pretty weak. Probably the GDP will come in even lower than the third quarter number. Do you think that's a given? We are going to have a weaker fourth quarter?
That's right. Based on the calculations, we now estimate that what the CSO is saying is the Q4 GVA will be 6.4% and GDP will be 6.5%. So again, if you look at the Q4 numbers of last year, again, which are all imputed because we don't have all the quarterly numbers available, so the base is relatively strong in some of the services sectors. Also, we have to understand that I think the government balances are under a lot of pressure in terms of trying to maintain the fiscal deficit target. So it's possible that the government was also forced to cut some spending, say in March, which would also kind of impart downside pressure on public administration and defense component of the services sector. So there can be some downside risk even to these imputed values. But by and large, broadly for the full year, I think 7% on the GDP growth is something which we are sticking to at this point of time.
Okay, you're sticking to 7% GDP. Dr. Sen, let me not ask you any leading question. What are your key takeaways? The message the CSO has given us today is, compared to their just month ago estimates, they are estimating now that the economy will slow down to 7%. And we have, of course, a third quarter GDP of 6.6. What are your key takeaways from today's numbers?
Well, a couple of things. The first, of course, is that the slowdown in agriculture, which is quite significant, is something that we should have expected. The agriculture numbers were starting to look extremely bloated. And this is much more in line with what happens in agriculture. So I think it's a good thing, nothing to get worked up about. Now, I think you have to understand the key difference between the first advance and the second advance estimates is that you get the SEBI advanced filings for the third quarter as well.
Okay.
So that's the additional information that is being used, and what these numbers are suggesting is that that's what's turned weaker.
Oh, okay.
Now, going forward into the fourth quarter, we have to remember we are now in an election year. And the quarter before elections usually sees a spurt in demand, which is caused by nothing other than the elections itself.
Okay.
Right? Now, the way one does these advance estimates is you assume that patterns that existed in the past will continue for the present as well.
Okay.
Now, in an election year, that won't work.
Okay.
So I would tend to think that the fourth quarter may give you an upside surprise.
Okay.
Not for any other reason, not because things have actually improved, but this is where election spending starts happening, and it should be happening anytime now. And that gives a boost, albeit a temporary boost to the economy, and then the economy slides back following the elections.
Okay. Well,
so
actually,
the fourth quarter may give you an upside surprise.
Yeah, you know, I was going to come to you to ask you about the private consumption numbers, which look very strong even for Q3. But before that, Dr. Sen, you know, the first 2 months of this year, of this quarter, are already over. We have only 1 month of March, and the government is a bit preoccupied with border issues. Now, probably it will be able to use the last 28, 25 days for what you call, you know, spurting consumption. Do you really think it has that much elbow room? Especially because we are also battling a rather broken debt market and stringent liquidity conditions. So do you think that that usual pre-election consumption spurt can come at all this time?
Well, you know, Lata, it doesn't depend upon the government.
Okay.
The pre-election spurt comes because of the political parties. They start to open their treasure chests.
Okay.
That's what happens. Now, you're right. If liquidity had continued to be tight, then one would have had huge question marks opening up. But the RBI is now on a liquidity expansion overdrive. So I suspect the liquidity will be there for the pre-election surge to happen.
Okay, well, let me toss the same question to Prasanna, because he makes a living by looking at the liquidity conditions in the market and what the bond markets are telling him. First of all, Prasanna, your estimate of this private final consumption expenditure for the third quarter, it is at a solid 8.3%. If you look at the obvious indications of consumption, you know, cars and two-wheelers, they've done terribly in November and December. Do you believe this 8.3? Or will it get revised?
Well, so I mean, obviously it doesn't kind of sync well with the other high frequency data and the narrative that we have currently. And I guess we have to remember, probably for the quarterly data, I think the breakup on the expenditure side, I don't think CSO gets as much information as one would like. Probably when finally the revisions happen, and after 1 year actually, right? Yep. So that's when I think they have the full information available. So to that extent, I think one shouldn't kind of dwell too much on these quarterly numbers, at least on the expenditure side. Okay,
but what's your estimate of the fourth quarter itself? Do you think we are going to see continued weakness because of what you observe in the debt market? Or would you go with Dr. Sen that maybe political parties can spend and we could get a slightly better fourth quarter?
Well, that's always possible, but probably I guess the trigger for that would be when actually the elections dates and whatever the entire schedule gets announced. Maybe if that gets delayed till the middle of March, then maybe probably a lot of that bounce could come only in April, and so maybe it will not happen in the fourth quarter. But as far as the conditions in the bond market or the liquidity conditions are concerned, I would say that actually the liquidity conditions at least are definitely much better. I mean, seasonally, of course, liquidity is tight this quarter, but compared to where we were, say, last year, September, October, from that, I think the way RBI has been managing the situation, things have improved. Now, in terms of obviously ability of companies to raise money, I guess things have turned a bit tight, but that is, I mean, and that is something which I guess it started way back in August. So obviously maybe there's not a significant improvement in that. But still, if you again go back to October, probably the bond market came to a standstill. Compared to that, I would say that things have definitely improved.
Oh, okay. That's good to hear. Actually, Dr. Sen, I also wanted to ask you about capital formation. If you looked at gross fixed capital formation only for the third quarter, it's come in at 10.6. That's a little slower than the 12.2 that last year's number indicate. But I guess a 9-month number would be better. And if you looked at the 9-month number, it is 10.8% versus 8.4. So clearly capital formation has picked up. Do you think it can continue? Because these first 2 months, Jan and Feb, we have seen tight liquidity conditions and also poor consumption numbers from the previous quarter. So do you think that capital formation can continue unhindered? Government is not going to do much or has not been doing much because they're using their cash for farm income.
Well, the recent release by RBI suggests that credit demand is down in February. Now, if that is the case, whether that's an aberration or that's showing a turning trend is really the question. But the real issue is that, look, there is liquidity, but we've been talking about this huge increase that's taken place in currency in circulation.
Yes.
And everybody's been wondering what on earth has been happening. I mean, you're back to the pre-demonetization levels and above.
Yes.
So there was a huge question mark. And I think much of it has to do with this whole election game.
Yes.
So looking at the credit market as if it were in some kind of a stable state, I think would be wrong. There are other forces that are at play out there. But weakening of credit growth is of concern because there's no obvious liquidity constraint. So this seems to be a demand side problem.
Okay, then hopefully the election expense and the farm income should be positive. Both the fiscal and the monetary stimulus has come in. A final question to both of you about FY20 itself. If you looked at the CSO's numbers, it was 8.2 FY17, 7.2 FY18 and now 7% FY19. Your best guess, Prasanna, for FY20, would we do better than 7? Just about same?
Yeah, so we do expect an improvement in FY20. In fact, our estimate at this point of time is 7.3%. Obviously, a couple of reasons. One is that I think oil prices have come off. So obviously, this year in the first half, actually, the economy was facing quite high oil prices. And compared to that, we got some relief in the second half. Now that relief will be there available for the full year next year. Also, there is going to be some sort of fiscal easing. I mean, even the interim budget suggests that, and it's possibly in the regular budget, we get a further fiscal expansion, and the states might also follow suit. On the monetary side, I'm a bit cautious. I mean, the RBI has been cutting rates, but the transmission is not happening. So probably that is something where I think we still have to wait and watch. But at least on the liquidity conditions, I do think the RBI has definitely turned a page. And I would expect into next year also they will be quite proactive in providing liquidity. So putting this all together, we are cautiously optimistic. Of course, the wild card is always how the global outlook shapes up. There does seem to be a significant manufacturing slowdown happening globally, and particularly concentrated in Eurozone and China. So if those conditions don't improve, then definitely that can have a negative effect on India. Okay.
Well, actually, since you brought up that point, the Reserve Bank is still working with some 7.4%, and they are still speaking of, output gap not being very pronounced, at least some of the MPC members. So now with the CSO itself cutting it down to 7% and, Q3 GDP, shouldn't you expect more loosening from the Reserve Bank? At least one cut in April.
Yeah, so we do expect one cut in April. In fact, that was something we penciled in even before this GDP data. Just
so now 2 cuts
based on the inflation trajectory, I mean, I would still think one cut at this point of time. And like I mentioned, since the regular budget does promise or looks to promise more fiscal easing, I would think the MPC would probably tactically cut in April and then wait for the budget and then decide on its next course of action.
Okay. Dr. Sen, your forecast for FY20, and more importantly, where does this leave the Reserve Bank now that we have lower than their expectations in terms of CSO numbers?
Well, as far as forecast is concerned, it's a little difficult to say. I think what we will get for the current year would be about 7%. Now, as far as next year is concerned, I think there are two contradictory influences that are working. The first influence is that, you know, post-election years always tend to show lower growth than the pre-election year. That's been the pattern. So one should then expect sub-7 next year. But on the other hand, if the PM Kisan works and it is followed through next year, it may just provide the requisite liquidity into the agri-markets to help an agricultural revival, which then in turn leads to a demand revival. So you have these two things working, but I would suggest it would probably be around 7% next year as well. Now, as far as the RBI is concerned, again, they need to be a little careful. You know, what you've been seeing is that liquidity has been sucked up, it's been hoarded, and it's going to start coming out now. And therefore, over the next 4 months or thereabouts, I think there's going to be a lot of uncertainty about how liquidity is going to behave. So if I were the RBI, I would plan for a rate cut, but I certainly wouldn't do it in the next MPC.
Okay. All right. Since you're the chairman of the MPC, the Citizens MPC, that's an important contribution, and you've normally got the Reserve Bank, right, sir? Thank you very much, Dr. Sen and Prasanna, for joining us with your analysis of the GDP numbers.